You are listening to ChartingWealth.com for the week beginning Monday, the 21st of March, 2016. This is our weekly review and forecast. What do we have going on? Well, we always open up with IYY, which has been in a crossover up move as far as our MACD crossing over moving up since the 4th of March. We actually saw the charts, the candlesticks turn around with green up moving candles all the way back on the 19th of February. So we have had good, consistent, strong up movement over the last 5 weeks. The week ended with IYY on Friday up 0.36%. Now be aware, this coming week is only a 4-day week, Good Friday. The markets will be closed this coming Friday. So let's look at what happened over the course of the week, because we always look at the weekly chart. Then we look at the daily chart to see what happened. Well, the week started on the 14th. The market was up. It was down a little bit on Tuesday, the 15th, and then moved up nicely on Wednesday, Thursday, and Friday. And again, we're looking at the Heikin Ashi type of candlestick pattern. It is different from the high-low open close. It uses a different formula. You can find that at Investopedia. Just look up HEIKEN-ASHI. We also have a teaching on that at our website, chartingwealth.com. What you will find, what I find, is that type of candlestick patterning works a whole lot better than using the standard type of candlestick. It also flows better, gives you a much better feel for the movement patterns of the waves in the market, I find, and a lot of people agree with me. You figure it out. If you like the old way of doing it better than the Heikin Ashi, then use the old way. Again, this is all about giving you concepts to study and you making up your own mind. So the market up on Monday, sideways, up on Monday and Tuesday, sideways on, up on Monday, sideways Tuesday, up Wednesday, Thursday, Friday. The market rolled over on the daily chart going up since the 16th, and soon thereafter the derivative oscillator rolled over. And when I say 16th, I'm going all the way back to 16th of February. It's continued to move up, well, pretty much since then. A couple of days we had some down movement, but the pattern itself, as far as the derivative oscillator and the MACD, moving average convergence divergence indicator, has been in an up pattern, although it does appear to be getting closer and closer as the market gets higher and higher, which means at some point everything that goes up does come down. Isn't that right? Yes, it is. Now, let's go back out to our weekly chart. We'll take a look at the S&P 500. What do we see going on there? Well, it crossed over going up on the 4th of March. That's the week ending the 4th of March. Actually, 5 up candles, similar to the total market. A nice steep climb on the S&P 500. Derivative oscillator and the MACD crossed over at about the same time at the end of the week ending on the 4th of March, and have continued to move up substantially since then, diverging the signal line and the MACD, and of course the derivative oscillator getting stronger and stronger in a green up pattern. Now, if we look at what happened throughout the course of the week on the daily chart, of course, the market opened strong on Monday, and again, spinning top, a lot of indecision on the 15th, Tuesday, and then up moves throughout the rest of the week, although technically on Friday, the S&P 500 was down 0.12%, but just a small fraction. Now, let's range back out on our weekly chart and take a look at the Qs. Now, what is the Qs? The S&P 500 is, of course, shown to us by SPY. The Qs is the NASDAQ 100. It just crossed over really over the course of the past week did it actually cross over on the MACD. Derivative oscillator started moving up on the week ending Friday the 11th of March, but we have 5 candles having started its up movement without a crossover at that point on the 19th of February, just like the other 2 indexes that we've talked about, the total market and the S&P 500. Again, upward moving candles in an up movement on the large chart. What's going on the smaller daily chart? Well, we see that there was on the 14th up movement, a little bit of down movement as far as our candle goes on the 15th, the red open box candle, then up movement on the 16th, the 17th, and then a red open box down candle on Friday. Technically, the Qs was down 0.14% above on all of these above the 2-day trend lines. Does look like the derivative oscillator is continuing to build its energy, but it does appear that the MACD and the signal line are getting a little closer together. Again, no crossover going down, still room on the volatility bands, which are depicted on our chart by blue dashed lines. There's still movement space available before they go out of the oxygen, as we call it. And of course, a lot of movement available down on those bands. So we will continue to watch. So again, just be aware, our charts are in confirmed up moves on the daily and the weekly charts. Strong up movements on those weekly charts over the last 5 weeks on all of our 3 indexes. That is the total market, S&P 500, and the NASDAQ 100. Now, lastly, before we go to the news that changed things over the course of the past week and things that might affect the market over the course of the new week, let's take a look at gold. We're going to range back out on our weekly chart. Take a look at gold. Gold was down technically on Friday, 0.27%. Gold crossed over going up right at the beginning of the year as the market started moving down. So did the derivative oscillator flip over, and we've seen the market on gold move up since then. Still a lot of distance that has to be covered for gold to flip over going down. A lot of push moving gold up, particularly in the huge week of Friday that ended Friday the 12th of February. The market opened, it had a low, well, the market opened at 107.66 that week. It actually had a low of 107.66, a high, get this, of $120.87, and then it closed at 116.46 that week. And that pretty much held as the high for the following 2 weeks, and then the market took off again in gold, ended over the course of the past week with a red candle with a lot of movement both above and below the movement of the candlestick itself, what we call wicks above and below. Derivative oscillator losing some of its speed. Now, if we look at the daily chart to see what happened during the course of the week, gold on the 14th opening day actually moved down the 14th and the 15th. A lot of indecision shown with a spinning top on the 16th and then up strong on Thursday. And then again, sort of another indecision day on Friday. Gold, unlike what you see on the weekly chart, the daily chart is in a negative pattern, not in an upward pattern on gold. So it's crossed over going down now. It could be crossing over, going back up again. If it is, of course, those of you who do some long-term trading, you might consider getting into gold on an up move if indeed that occurs. But again, gold is getting long in the tooth on a lot of that upward movement, so be careful there. Now that is where, excuse me, we end the market review, but we want to talk about what actually moved the market potentially over the course of the week and what we might see happening. Now, again, we always give you this caveat. We talk about the charts, how important it is to read the charts. Why? Because the charts are like a roadmap to what has gone on in the market with the indexes you're looking at, with the commodities you're looking at, with certain stocks. It is a roadmap. Does it mean that the market will move in the direction it appears it's going to on the charts? No, but it does give you a heads up and a bonus when you start learning how to trade and invest well using the charts, no matter what other information. You know good things about a company. You look at their books and you really figure out, hey, this is an undervalued stock. Well, don't ever buy an undervalued stock at the top of the market. Well, wait for it to move over and come down if you learn to follow patterns, to read patterns, to follow charts. Always buy right. Why would you go to a car dealer and pay full price, the sticker price on the car, when you know you can wheel and deal buy it at certain times of the year when maybe they're trying to clear their inventory and the prices are lower. There are all sorts of good times to buy. That's what we try to find. And also good times to sell when something has topped out and is a lot higher than maybe it even should be, thanks to maybe the economy doing great or great news coming in. And what happens when the tide comes into a harbor? It floats all the boats. Okay, let's talk quickly now about what went on during the course of the week that ended the 18th of March 2016. Well, we saw that the Federal Reserve dialed back its expectations and basically told us that the Federal Open Market Committee was cutting its forecast for rate hikes in 2016 from 4 of them to probably 2 of them, that the market's been pricing in a much less aggressive policy than's been forecasted by members of the FOMC. And we will continue to see how that plays itself out, probably with the market going higher and higher. So again, as long as there's free money out there, as long as that money is free or almost free, or even they're paying you with negative interest rates, which they're not doing yet here, but they are in other parts of the world, it just gets crazy. Now, what about oil? Well, oil finally pushed itself above after the Federal Open Market Committee's dovish outlook. What did we see happen? Well, Brent crude and WTI both pushed through $40 a barrel. There are hopes that production cuts and dwindling fears of a global recession could contribute to continued recovery in other commodities, including crude, so keep that in mind. We also saw European leaders meeting to address migrant issues. Again, stuff like that has been weighing on the economies in Europe, causing problems. And if we look at now what's possibly moving the market in the week ahead. Now, we don't have a Federal Open Market Committee meeting like we warned you about last week that happened last Wednesday, but we do have several different things happening again in this shortened trading week. On Tuesday, German WEZ survey is going to be released. You're going to see on Thursday, U.S. durable good orders are going to be released along with UK retail sales. Also, flash global purchasing managers indices are going to be released that same day. Again, is that going to be a lot to push the market around? Unless there's something really shocking, probably not, unless the market wants it to. So again, pay attention, watch the charts. A lot of times you can see these things setting themselves up. And if you follow the charts, read the charts, hopefully you are surprised less and less, or if at all. Okay, now also be aware, like we said before, the markets in Europe and the U.S. are going to be closed for Good Friday on the 25th. The U.S. is going to release its GDP Q4 data on Friday with the revision. The final revision is going to be released on Friday. So that is where we've come from over the course of the past week and where we might see things going over the course of the coming week. I encourage you to please continue to follow us every day. Listen to our podcast, the Daily Review. Get, if you don't already have it, our charting layout so that you are able to help yourself figure out just what's going on, chart these patterns, practice with us, and then when you get good enough, you can make your own decisions. We're not a stock calling service. We don't give you investment advice. We're an education firm. But we want you to get good at what you do, because this kind of information can separate you from the pack and can help you become a powerful, successful trader, investor, somebody who can look at a chart and then be able to determine what are the best moves for you to make. It is a roadmap, and the more you practice using the roadmap, navigating by it, getting better and better with it, learning patterns, learning how to use this information, you're going to be more and more powerful, and it can potentially spell more and more wealth. And you not getting hit with huge crippling losses when there are market downturns or things are not going as expected. Folks, that's where we are, chartingwealth.com. We're here to help you. We love to hear from you. Follow us Facebook, Twitter, Instagram, YouTube. We are there, and you should be there with us. We love to hear from you. Thanks so much from chartingwealth.com.